A mixed close on Wall Street, but the Nasdaq surge is led by a 6% rise in Tesla. The Dow and S&P 500, however, closed lower. Stocks in the Europe region continue to rally. Markets hit levels last seen in May of 2022. Stocks in the Asia Pacific drop off after a strong start. The SGX Nifty indicates a lower start for the Indian market. Crude prices rise. Brent hit $79 a barrel as demand concerns ease on China reopening its borders. A weaker dollar and hopes of less aggressive interest rate hikes also aid the move. And TCS's third quarter revenue beats expectations, although margin mildly misses estimates. Deal wins fall sequentially and headcount also declines. The management, however, says there is no material change in the demand environment. Market regulator SEBI releases guidelines for handling outages on the exchanges. All market participants are to be promptly informed, while trading hours will also be extended if trading does not return to normal an hour before the scheduled close. Hey guys, good morning and welcome to Power Breakfast. I'm Pavitra Parekh. Those are the top headlines that we're looking at as we start this fresh trading day. There's lots for us to talk about, but first up, let's take a look at what's going on across the Asian markets. It's pretty mixed right now. What's definitely doing well is the Japanese markets. Remember, they were shut yesterday for a public holiday, but today they're doing quite well, up around 1% in trade. You also have Taiwan and Kospi, which are seeing some green right now. Taiwan is up on your screen, just a little bit of green over there. Kospi is doing pretty well. It's around 0.9% higher, but the rest of the Asian markets are seeing some cuts right now. So the Hong Kong market is down around 0.4%. You have Straits Shanghai also seeing just a minor downtick. So no big losses coming through from Asia, but you do have a few of the markets which are doing well, the likes of the Japanese and Korean markets. The SGX Nifty will also come up for you. There you have it on your screen. It is around 26 points lower right now. So maybe a lower start for us, but let's see how the rest of the session pans out. That's what's going on across the Asian markets, but let's also talk about the US now. Wall Street ended Tuesday's trading session mixed, so the Dow Jones fell around 112 points. The S&P 500 also closed, it was pretty much flat at the end of the trading session, and the tech-heavy Nasdaq notches its second day of gains, so it closed around 0.5% higher. This is after the kind of move that we'd seen yesterday as well, and mostly on account of what happened with the Tesla shares. CNBC's Steve Kovac is here to bring us a wrap of all of that action from Wall Street.
Wall Street trying to build momentum for a rally to begin the new year, but comments from a key Federal Reserve official that the central bank is ready to keep interest rates higher for longer, causing the major averages to cut their earlier gains. The Dow finished down 0.33%. The S&P was nearly flat. The Nasdaq up over 0.5%. Goldman Sachs is set to cut up to 3,200 jobs this week in its biggest workforce reduction in years. Many other Wall Street firms are considering layoffs, but are waiting to see revenue numbers for the first few months of the year before making final decisions. And Walt Disney CEO Bob Iger is telling hybrid employees they have to be in the office 4 days a week starting March 1st. In an email obtained by CNBC, Iger says in-person collaboration is especially important in a creative business like Disney. That's the U.S. action. Back to you in Mumbai.
Steve, thanks a lot for getting us all of that action from Wall Street. But on that note now, let's also bring you the latest on what commentary from key Fed officials suggests. Remember, members remain quite hawkish despite signs of inflation cooling in the U.S. So CNBC's Steve Leisman filed this report for us.
San Francisco Fed President Mary Daly just now on the wire saying that both a 25 and a 50 basis point rise is in play for the January-February meeting, and that it's too soon to declare victory and stop hiking rates. While she said the Fed is data dependent, some are questioning whether that's true for the Fed as a whole and whether the Fed is headed higher regardless of the data. Atlanta Fed President Raphael Bostic telling me last week there's more work to do. He joined Esther George from Kansas City in saying that they're going to hit that 5% rate and likely stay there well into 2024. Tom Barkin from Richmond saying the inflation fight isn't over. And the minutes of the meeting that came out last week say no Fed official is forecasting cuts in 2023. Meanwhile, you had the ISM services sector contracting for the first time in quite a while. December wage growth slowed. November was revised down sharply. And the 5-month annualized inflation rate running around 2.5%. To be sure, the unemployment rate did fall. It was down by 0.2, suggesting the job market is still tight. But look at how the job market reacted to all this on Friday. The the bond market did. The 2-year fell in 2 steps from both the jobs number and the ISM services data, a sign that it sees both inflation and economic weakness ahead. The appearance, at least by looking at their comments, is that Fed officials are not really data dependent, but instead they act like they have a date with 5% or higher almost no matter what happens here. Columbia professor Charles Calamara is telling me over the weekend what's strange at this moment when things are so ambiguous is for the Fed to be acting like their actions are so predictable. Okay, the Fed may have it right. Inflation may end up being persistent, or they could be making a mistake similar to the one they made last year when they nearly all decided, wrongly it turned out, that inflation was transitory. Rather than a debate and different takes on the data, they all sound like they're talking from a script that instead ignores the data.
All right, that is a wrap-up of what the Fed commentary is really suggesting right now. But on that note, let's also listen in to Liz Young, Head of Investment Strategy at SOFI, on the inflation trajectory as well as the outlook for the U.S. markets.
It's possible and probable that inflation comes down pretty well in the first half. It might come down very, very quickly, and the market is going to cheer that. The move on Friday was really predicated almost solely on the fact that wage growth relaxed. And we got this jobs data on Friday that kept the hope for a soft landing alive. The only thing I would caution people on is that the stock market and wage growth alone does not reset the economic cycle, does not solve all of the problems that we have. The risk of a wage price spiral maybe got reduced for a little while, but that doesn't mean that the risk is gone. And what we're seeing right now, especially in some parts of the labor market, definitely parts of the consumer data, is that economic data is weakening. If you want inflation to come down, you have to bring demand down. That affects consumer spending, that affects corporate profits. I don't think we've seen the end of the bad news. I'm not a short-term trader, so if you look at just where would the growth be, where would I bite if we're trying to find growth, it's probably not in tech, it's probably not even really in large cap at all.
All right, that is some important opinion coming in on the markets. But with that, let's also bring you the final update on our global market wrap this morning. European markets rose to their highest levels that we've seen since May of last year. That's May of 2022 at the start of the new trading week. So the French CAC index was up 45 points. The DAX index surged over 1%. And the FTSE also saw a 26-point higher gain at the close. In fact, industrial production in Germany beat expectations in November. And the output rose 0.2% on a month-over-month basis. This is against a 0.4% decline in October and a better than expected street expectations of a 0.1% growth. Some more data coming through. Unemployment in the Eurozone hit a record low in November, despite slowing economic growth in the region. The jobless figure stood at 6.5%. This is for the month of November, which is the lowest that we've seen since 1998. And this is in line with what the street was expecting. And finally, the Swiss National Bank also reported a preliminary loss figure, 132 billion Swiss franc, which is the biggest loss that we've seen in the bank's 116-year history. As a result, the bank will not be making its usual payouts to the Swiss government, and payouts to shareholders are also due to be affected. So that is some important data and news that's coming out of the Europe region that we are tracking for you. That's everything that's going on globally. Let's talk about the cues you should track as we get into a fresh trading session. We have our research team here with the trade setup. Mangalam, Vahishta and Ekta all join me now. Guys, a very good morning to you. And Ekta, let me come across to you first. The rally for our own markets continues.
Thanks for that. Well, yes, in fact, the markets did snap that 3-day losing streak. The frontline indices rose around 1% each. FIIs net sold marginally around 200 odd crores, but net institutions were buyers because of the DIIs, which bought close to over 1,700 odd crores in yesterday's trading session. There was buying, which was visible across IT, metals, PSU banks, autos as well. So there was broad-based buying which took place. Overnight, US mixed close, but the Nasdaq has gained. So that's a positive. A lot of the beaten down shares such as Tesla has seen buying at lower levels. European markets, there's been optimism because it has closed at the highest levels that we've seen since May of 2022. Asia largely in the green. China is reopening its borders with Hong Kong, so there's largely a lot of optimism on account of that. SGX indicating a bit of a soft start. Crude, there is some amount of demand optimism that you can see, so $79 to $80 is currently where Brent crude is. TCS revenue beat, margins in line, so that will be reacting to its numbers. lot of cues on the macro front. We have the Fed chair speech today, which is basically a panel discussion in Stockholm. CPI data from Tokyo, which is due today. India CPI as well as IIP on Thursday, along with the US CPI data, which will be closely watched, along with CPI from China as well. So a lot of inflation data, which we will be reckoning with this week. UK GDP numbers, and back home, lot of earnings. Infosys, HCL Tech, Cian, to name a few. Wipro as well as the likes of Just Dial. We'll close the week on Saturday with HDFC Bank and Avenue Supermart.
All right, Ekta, thanks a lot for taking us through all of those cues as we get into this fresh trading day. But let's now talk about the individual names that you should have on your radar. And, earnings season has officially started. So, Varishta, TCS is going to be top of mind.
That's right. TCS is the big one in the IT pack. And like Ekta mentioned, the results were out. There was a beat on the top line. The management says that the overall demand environment, in fact, has not changed materially, but margins have seen a very slight bit of miss. Management has sounded cautious on the European market. The attrition rate is nearly same as the last quarter and is coming at 21.3%. But for the very first time in many quarters, the total headcount has reduced by 2,200 employees. The order book, though, is lower in this quarter at $7.8 billion. Moving on to Reliance, wherein Jio has launched 5G services in 10 more cities. This includes few in UP, in Andhra Pradesh, in Kerala and in Maharashtra. The next is Tata Motors, wherein for Tata Motors, the Q3 business update is out. The global wholesales are at 3.23 lakh units, which is up 13% on a year-on-year basis. For JLR, the wholesales for Q3 is up by 6% on a quarter-on-quarter basis, which comes to 79,000 units. Sona BLW Precision, which the company has acquired 54% stake in a Serbian company called Novelic for approximately 41 million euros. And the last stock is IRB Infra Developers, wherein the December toll collections are out. It is up 6% on a month-on-month basis and up 32% on a year-on-year basis, and has come in at 388 crores. Back to you.
All right, Vaishta, thanks a lot for bringing us all of that stock-specific news. That's a lot of stocks for us to, watch for in today's trading session. Finally, let's talk about all of the cues from the futures and options space. Mangalam, we were just saying yesterday was a good session. We saw broad-based buying, but how's it looking this morning?
Well, it's looking good even today because despite the SGX Nifty indicating downtick. Why is that? Because yesterday's rally was led by three factors. The first one was lower selling by FIIs in the cash markets, higher buying by DIIs. Secondly, there was a lot of short covering in index futures. The market was poised for that. And then there was also a lot of short covering in index calls. So let's take each of them, individually. Cash market flows. The FIIs sold just about 203 crores. The DIIs went ahead and bought 1,700 crores. So that brought in around 1,500 crores on a net basis from the institutions. In index futures, we saw that there was an open interest decline in both the Nifty as well as the Nifty Bank, with the market moving higher, and that suggested that there could be some short covering. And the data also confirmed that. The FI has bought 2,200 crores in index futures, added about 7,000 long contracts and covered 16,000 short contracts. So as a result of which, in one trading session itself, the FII longs jumped from 41% all the way up to 49%. So now long and shorts are at an even keel. The other part is that there was a big call selling in the previous trading session, and those call writers have unwound their positions. So 45,000 calls were unwound, whereas 63,000 short puts were added on the short side. So that's telling you that there is support as well. Let's take a look at these levels. Then 18,000 calls shed almost 60 lakh shares in open interest as the market went past that 18,100 mark yesterday. 18,000 put writers were extremely active, wrote almost a crore shares in open interest for 40 rupees a pop. That's telling you that 17,950 to 18,000 is an important support zone. We saw some writing at 18,100 as well. The Nifty put call ratio from oversold levels of 0.75 has jumped to closer to 0.1. SGX Nifty is indicating a dip. Important to see whether this dip is bought into, because on the way up, then we have some resistances to run. The Nifty 20-day moving average at 18,200 and Nifty Bank 50-day moving average at 42,700. Finally, everyone's talking about TCS. The FNO positionings indicate that the TCS range for today could be 3,400 to 3,300 on the bottom end.
All right, that is everything in terms of the cues and stocks that you should watch for in today's trading session. Mangalam, Varishta, Ekta, thank you very much for joining us and prepping us up for this trading session. With that, it's time for our first short break on the show. But when we come back... Hey guys, welcome back. You're still tuned into Power Breakfast, and like we've been talking about all through the show so far, it is going to be all about TCS because it's really kick-started the earnings season. So Rima is joining us with the fine print and to really break down all of the earnings. Rima.
Thanks so much for that. It's a pretty good showing from TCS this time, not as bad as what the markets were fearing. The company's reported a dollar revenue growth of 2.9%, constant currency revenue growth of 2.2%. This is better than what the street was anticipating. Margin improvement at 50 basis points is a bit muted. Margins have come in at 24.5%, but the management is confident about margins improving to 25% by Q4. Profits slightly lower than what the street was anticipating on the back of lower other income. The other few important internals: deal wins steady, $7.8 billion, lower than the prior quarter, within the company's guided band. Attrition has fallen by 20 basis points on the last 12 months basis. This is after 6 consecutive quarters of an increase. So that's a positive, and the management seems to indicate that the quarterly annualized attrition has fallen a lot faster. The muted number this time has been the fact that the headcount, the overall headcount, has declined by nearly 2,200 employees, the management says, and that's because we had hired 42,000 freshers so far this year, and that's the reason why the hiring has been muted. There is a special dividend as well of 67 rupees, taking the total dividend to 75 rupees. That's something the street will like. So in a nutshell, Q3 has not been as bad as what the markets were fearing, though the management is sounding a bit cautious on Europe, even as North America continues to hold up pretty well.
All right, Rima, thanks a lot for bringing us all of the details from TCS's third quarter showing. But let's also hear it out from the management on how they look at the results and their outlook going forward.
So overall, demand scenario has not changed significantly. But to be fair, it would take at least a couple of months more for us to actually know what the decision making is. We have gone into December with everybody being cautious. But our view is that this caution has different color across markets. So if you look at Europe, there is obviously a real big issue out there. And it would take some time for this caution to dissipate. And we need to be cognizant about that, and we'll see where it goes.
Seasonally speaking, this quarter we had certain furlough impact, more in Asia Pacific than in other parts of the world, but nothing special to call out. It's more or less the same that we typically face in this particular quarter. The deal momentum, the deal pipeline looks really good, and our qualified pipeline has actually gone up, okay, both in terms of medium to small deals as well as the large deal pipeline. So on that count, I have no concerns, right, where we are today with respect to the deal momentum. And at this time of the year, every year, where we are comparatively, we are feeling there's a feel-good factor about it. I don't think there is a risk to it because of the pipeline that I see, barring the uncertainties that you see and we see and what Rajesh articulated.
All right. In fact, remember, we will also be speaking with the TCS top team to discuss their Q3 numbers at 8:25 a.m. today. So you want to stay tuned for that big conversation. All right, that is on TCS, but some more important news coming in. The SEBI has released guidelines for exchanges on how to deal with outages. So all market participants are to be informed about the disruption to trade within 15 minutes of any incident taking place. Any updates on outage must also be provided with every 45 minutes. According to the guidelines, a pre-opening session must also be conducted for price discovery ahead of resumption of trade. And remember, exchanges will also have to inform stakeholders about resumption of trade at least 15 minutes in advance. Some more from the guidelines. It also states that if trading resumes normally at least 1 hour before the usual closing time, trading hours will remain unchanged. But in case trading does not resume an hour before normal market close, all stock exchanges will have to extend their trading by an hour and a half. Now, in case of an outage in the last hour of trade and before 15 minutes of market close, trading will be extended by 1.5 hours. And in the case of trading not resuming even 45 minutes after normal trading hours, so no further trading will be allowed on the exchanges for that specific day. So these are some important updates coming in on how exchanges are to conduct themselves in case of any outage. But with that, we're going to get into a short break now. On the other side, we shift. Hey guys, welcome back. You're still tuned into Power Breakfast on CNBC-TV18, and let's now talk about the world of commodities. Manisha joins us for a quick update. Manisha, there is a rise in crude prices overnight.
Oh, it is, yes, and there are recovery hopes from China coming in. China has announced financial support for households and companies. So this constant push that China is doing into the market to improve the demand outlook and economy is definitely supportive. So we have seen crude oil prices gain on demand optimism. Overnight was great. Asia hasn't been able to hold those kind of gains, is what has led to some decline coming back in yet again. But it is the metal prices that you have to keep an eye on, because apart from China, it also has to do with the fact that you are looking at elevated energy prices melting in Europe and Africa. There is sharp fall overnight in the US dollar index, which has been supportive. So you have the steel prices trading at a 4-month highs, copper is trading at a 6-month highs as well. Silver is trading at 8-month highs, iron ore prices at 5-month highs. So the metals rally for a second straight day seems to be holding in the Asian markets yet again.
All right, Manisha, thanks a lot for bringing us all of that action on the commodity front. With that, we're going to wind down on this edition of Power Breakfast with the news that the Nikkei markets are doing well, but the rest of the Asian markets have slipped from the opening highs. The SGX Nifty is around 25 points lower. Thank you for tuning into Power Breakfast. Bazaar Morning Call when we come back.
QCI